Right now, SoFi Technologies, trading under the ticker SOFI, is at $29.32. That is a sharp drop of $1.58, or 5.11% in the middle of today's trading session on October 30, 2025. This stock has been trading in a volatile range today, from a low of $29.23 to a high of $30.91. This immediate aggressive downside move is likely catching many investors off guard, especially because it comes just 2 days after the company reported what was, by all accounts, a blowout third-quarter earnings report. The expectation, the narrative that has been building for months, was that another strong, gap-profitable quarter would send this stock decisively into new highs. But the reality of the market today is a deep red candle, suggesting that despite the flawless print, the market is aggressively taking profits. This is the classic frustrating sell the news event, and it forces us to ask a much harder question. If a record-breaking quarter can't sustain the price, what will? The common belief surrounding SoFi is that it is the definitive fintech super app in the making, the one-stop shop for an entire generation's financial needs. Investors look at the charismatic leadership of CEO Anthony Noto, the sleek user interface, and the relentless member growth, and they see the next great American financial institution. They see a tech company that just happens to have a bank charter. This perception was powerfully reinforced just 48 hours ago. The company announced record third-quarter net revenue of $962 million, a 38% jump from the previous year. They posted strong GAAP net income of $139 million, or 11 cents per share. This wasn't just a squeak into profitability, it was a 120% increase in earnings per share from the same quarter last year. They added a record 905,000 new members, bringing their total to 12.6 million. Everything the bull case rests on, member growth, product adoption, revenue acceleration, and profitability, was confirmed. And yet, here we are, watching the stock bleed out in real time. The deeper, more complex reality is that SoFi is a battleground stock, fighting a war on two fronts. It's fighting to be valued as a high-growth technology platform, while simultaneously being anchored by the market's perception of it as a banking business, a bank, which is subject to cyclical risks, interest rate pressures, and intense competition. Today's price action is a clear signal that the market is more focused on the latter, perhaps fearing that the stock's massive run-up, a 340% surge over the last year and a half, had already priced in this perfection and then some. Looking closer at the recent market dynamics, this pullback, while sharp today, follows a period of immense strength. The stock hit a new all-time high just after the earnings were announced, touching levels it hadn't seen before. This suggests that short-term traders who bought in anticipation of the beat are now closing their positions. The average trading volume for SoFi is immense, often exceeding 70 million shares a day, making it one of the most actively traded and discussed names on the market. This high volume means that moves, both up and down, can be exaggerated as algorithms and retail traders pile in. The current macroeconomic backdrop isn't helping either. While the Federal Reserve has signaled a pause in its rate-hiking cycle, interest rates remain elevated. This creates a difficult environment for lending businesses. On one hand, SoFi can earn more on its deposits. On the other, high rates can stifle demand for new loans, particularly mortgages, and increase the risk of defaults on personal loans. The market is weighing SoFi's excellent credit performance, with personal loan net charge-offs actually decreasing to their lowest level in 2 years, against the systemic risk that this good fortune can't last forever in a strained economy. The stock is reacting to a broad-based profit-taking wave in the fintech sector, and as a high beta name, SoFi is often hit harder than its more established peers. But while the intraday chart looks painful, the institutional data tells a very different and far more optimistic story. This is where the tension between expectation and reality becomes most clear. Recent 13F filing data, which shows what the largest funds are doing, is decidedly bullish. SoFi now has 1,124 institutional owners, an increase of nearly 11% in the most recent quarter alone. These large, sophisticated investors, the smart money, have been increasing their positions, not decreasing them. Institutional shares held have risen by over 12% in the last quarter. We can see specific, large-scale buys. Mizuho Markets Americas, for example, upped its stake by a massive 184%, adding 2.7 million shares. Sumitomo Suite Trust Holdings, a major global player, increased its position by 87%, acquiring another 6.3 million shares. These institutions are not day trading. They are making multi-quarter, multi-year strategic allocations. They are buying into the long-term expectation that SoFi's business model is superior and that its current valuation, even after the run-up, will look cheap in a few years. This creates a fascinating divergence. Retail and short-term traders are selling the news today, while long-term institutions have been steadily accumulating. This brings us to the other side of the trade, the short sellers. SoFi has consistently been one of the most heavily shorted stocks on the market. As of the most recent data from mid-October, there are still over 100 million shares being held short. This is a significant number, representing a massive bet that the stock price will fall. This figure is actually down from its peak earlier in the year, when it was well over 150 million shares. But 100 million shares is still an enormous position. The short thesis is straightforward. They believe SoFi is fundamentally a bank, not a tech company, and is wildly overvalued. They look at its price-to-sales ratio of over 10, which is more than double its 5-year average and far exceeds that of traditional banks, and they see a bubble. They are betting that loan loss provisions will eventually have to rise, that competition from giants like Block, Upstart, and JP Morgan will chip away at its growth, and that its high-flying member growth will eventually slow. For retail investors, it is critical to understand what this short position means. You can find this data yourself on the NASDAQ website or on financial data platforms like Fintel or Ortex. Look for the short interest percentage of the float. A high number means a lot of people are betting against it. Another key metric is the days to cover, which for SoFi is currently very low, at around 1.22. This is calculated by dividing the total short interest by the average daily trading volume. A low number like this means that if the shorts were wrong and the stock started to rise, they could exit their positions by buying back shares in just over 1 day. This makes a sustained short squeeze less probable, as there isn't a high risk of them getting trapped. What's your take on the 100 million shares short? Is that a sign of smart money betting on a fall, or is it just a hedge against a high-growth stock? Investors should also monitor the borrow fee rate. This is the interest rate that short sellers must pay to borrow the shares. If this rate suddenly spikes, it means the demand to short the stock is increasing dramatically, which can be a bearish signal. However, it can also be a precursor to a squeeze if the supply of shares to borrow dries up. This entire debate is playing out 24/7 on social media. On platforms like X and Reddit, the SoFi bulls are a dedicated, vocal community. For them, this earnings report was total vindication. They're focused on the long-term vision, the cross-selling, and the idea that SoFi is building an ecosystem that will lock in customers for life. They point to the fact that nearly 40% of new products in the quarter were opened by existing members, proving the super app flywheel is working. Today's drop is seen as pure market manipulation or paper-handed traders who don't understand the real story. They trust Anthony Noto and they are buying this dip. This retail conviction is a significant market force, providing a floor of support that many other companies simply do not have. To understand the future, we have to briefly look at the business itself. It's not just one thing. First, there's the lending segment. This is the original business: student loan refinancing, personal loans, and home loans. This remains the company's cash flow engine. The Q3 report showed origination volume was strong and credit quality was pristine, defying the high-rate environment. Next, there's the financial services segment. This is the super app part: SoFi Money, checking and savings, SoFi Invest, the credit card, and financial planning tools. This segment is the member growth engine. With 12.6 million members and 18.6 million total products,